In January of 2021, a 34-year-old man sitting in his apartment in Massachusetts made what felt in that particular electric moment like the most rational decision of his financial life. He had been watching the Reddit forum Wall Street Bets for weeks. He had seen the posts accumulating the memes, the screenshots of growing positions, the testimonials from strangers who had turned $500 into $50,000 in a matter of days. He had watched the charts. He had seen the numbers moving in the direction that everyone around him, everyone in that online community that had come to feel, somehow, like his financial family was saying they would move. The stock was GameStop, and the entire world, or at least the entire world that existed in his phone screen, was talking about it. He bought in on a Thursday. By the following Monday, GameStop's price had peaked at approximately $480 per share. He did not sell. The community was still talking. The community was louder than ever. In fact, the noise was extraordinary. He held. By February, the price had collapsed to $44. By June, it had fallen further still. He was not an idiot. He was not uninformed. He had made, by the standards of the information available to him in the channels through which he received it, what seemed like a reasonable decision. And he had been destroyed, not by ignorance, but by something considerably more dangerous, the illusion of collective intelligence. This is the story of that illusion. Where it comes from, why it is so persuasive, why it has existed in different forms for as long as organized markets have existed, and why the single most reliable warning sign that a stock is about to hurt you is the sight of everyone you know talking about it at once. The paradox at the center of this story is not comfortable. It requires us to accept that more voices do not produce more wisdom, that social consensus is not the same as correct analysis, and that the same human desire for connection and belonging that makes us social creatures also makes us, in financial markets specifically, deeply, systematically, almost beautifully destructive to ourselves. But understanding it may be the most valuable thing a person who cares about their financial life can do, because once you see the mechanism, you cannot unsee it. And once you cannot unsee it, the noise that once felt like signal becomes exactly what it always was: noise. The internet did not invent the crowd, it amplified it. Before we can understand what social media does to investment decision-making, we need to understand what crowds do to investment decision-making. And the story there is older and considerably more interesting than any Reddit thread. The economist James Surovitsky published a book in 2004 called The Wisdom of Crowds, and it made an argument that has since been so thoroughly absorbed into the popular understanding of collective decision-making that most people treat it as settled fact. The argument, briefly, is this: under the right conditions, large groups of people make better decisions than the smartest individual within the group. The classic demonstration is the famous ox-weighing experiment conducted by the polymath Francis Galton in 1907, in which a crowd of 800 people at a county fair each submitted their estimate of an ox's weight. The median of their estimates, 807 pounds, was within 1 pound of the ox's actual weight of 808 pounds. The wisdom of crowds in this framing emerges from the aggregation of independent, diverse estimates into a collective judgment that cancels out individual errors. It works when the estimators are genuinely independent of each other, when they are drawing on different information and different perspectives, and when no social pressure pushes them toward conformity. This is the theory. And the theory, under those specific conditions, is actually well supported by the evidence. But those specific conditions are precisely and systematically violated by social media. The architecture of every major social media platform, whether we are talking about Reddit, Twitter, YouTube, or TikTok, is designed around one overriding metric: engagement. Content that generates engagement is amplified. Content that generates less engagement is suppressed. And the content that generates the most engagement is almost universally content that triggers emotional responses: surprise, outrage, excitement, the particular electrical feeling of being part of something large and fast-moving. A calm, well-reasoned analysis of a company's fundamental value does not generate engagement. A post showing a brokerage screenshot with enormous gains, accompanied by rocket emojis and a message that reads simply, "This is it. We are all going to be rich," that generates engagement. It generates replies and upvotes and shares, and the cascading social validation that the platform's algorithm is designed to reward and that the human brain, for reasons we will examine shortly, is designed to receive with profound pleasure. The result is a selection effect. The investment ideas that achieve the widest circulation on social media are not the ideas that have been most carefully analyzed. They are the ideas that are most emotionally legible, most narratively satisfying, most contagious in the specific viral sense, ideas that spread not because they are true, but because they feel good to share. And once an idea is circulating at scale, something even more pernicious happens to it. The people who encounter it do not receive it as one data point among many. They receive it as social signal, as evidence of what their community believes, of what the consensus is, of which direction the herd is moving. And the human brain, as we will see, is exquisitely designed to update toward the herd, especially when the herd appears to be confident, growing, and moving fast. The conditions required for crowd wisdom, independence, diversity, decentralized information have been replaced by their precise opposites. Dependence on shared feeds, homogenization toward viral content, and centralized amplification of the most emotionally resonant ideas. What looks, from inside the experience of a surging Reddit community, like collective intelligence is, from outside it, a textbook example of collective delusion operating at algorithmic speed. This is the noise machine. And the noise machine, it turns out, is not new. It has been built before many times, in different materials, for different assets, by different generations of people who were also not idiots, who were also not uninformed, who also thought they were making reasonable decisions based on the information available to them in the channels through which they received it. The Dutch city of Amsterdam in the 1630s was, by the standards of the time, the most financially sophisticated place in the world. It was home to the first modern stock exchange, the Amsterdam Bourse, founded in 1602 to trade shares in the Dutch East India Company. It had banking instruments, futures contracts, and a merchant culture that was by contemporary European standards. Remarkably numerate and commercially literate, the people who participated in the tulip market of the mid-1630s were not, in the main, credulous peasants swept up in superstition. They were the educated commercial class of the most advanced financial culture in the Western world. And yet, the tulip introduced to the Netherlands from the Ottoman Empire in the late 1500s had become an object of intense horticultural fashion. Rare varieties, particularly those with the vivid color breaks produced by a mosaic virus that no one yet understood, commanded premium prices among the wealthy collector class. This was not at first irrational. Rare, beautiful, difficult to cultivate. Things have always attracted price premiums from those who can afford to pay for them. But somewhere around 1634, the market changed character. Tulip bulbs stopped being a commodity traded by florists and collectors and became an asset class, something you bought not because you wanted tulips, but because you expected the price to keep rising. Futures contracts were developed, allowing traders to buy bulbs that had not yet been harvested, for prices far exceeding anything a grower would have paid for the actual bulb. A single bulb of the Semper Augustus variety, the most coveted tulip of the age, reportedly traded for a price equivalent to a skilled artisan's annual salary multiplied many times over. The mechanism driving this is familiar. Word spread through the coffee houses and counting rooms of Amsterdam that fortunes were being made in tulip futures. People who had never previously shown any interest in floriculture began asking how to participate. The prices they observed rising were understood as evidence of demand, which was understood as evidence of value, which was understood as justification for paying prices that would have seemed absurd a year earlier. Each new participant, who paid a higher price, created the social proof that drew the next participant. In February of 1637, in the town of Haarlem, a scheduled auction of tulip bulbs failed to attract any buyers willing to pay the asking prices. The signal passed through the market instantly. Within days, the futures market had collapsed. Prices that had risen to extraordinary heights over 3 years fell by 95% or more within weeks. The people holding contracts at the top of the market had not been foolish by the standards of the information available to them in the channels through which they received it. They had been participating in what appeared, from inside the experience of a surging market community, to be collective intelligence operating at the speed of commerce. What they had actually been participating in was a reflexive loop, the expectation of rising prices creating demand, demand creating rising prices. rising prices confirming the expectation, the confirmation attracting more participants, the new participants creating more demand. The loop continues until the population of available new participants is exhausted, at which point the expectation reverses with a speed and violence that astonishes everyone who did not think it possible. The Dutch Tulip Mania is the oldest well-documented example of what Charles Kindleberger, in his landmark work on financial history, called a speculative mania, the same basic structure that has recurred in every major market bubble in the 4 centuries since. The South Sea Bubble of 1720, in which the shares of the South Sea Company rose to extraordinary heights on the basis of vague promises about trade monopolies that were never plausibly achievable. The Railway Mania of the 1840s in Britain, in which the projected profitability of hundreds of new rail companies attracted investment that bore no relationship to the actual capacity of the British landscape to absorb hundreds of competing railway lines. The American real estate bubble of the 1920s, the dot-com bubble of 1999, in which companies with no revenue, no product, and no plausible path to profitability commanded market capitalizations that dwarfed established industrial giants. In each case, the mechanism was the same. A genuine innovation or opportunity attracted initial investment. That investment produced returns. The returns generated stories. The stories attracted crowds. The crowds, by the act of their own arrival, drove prices higher, which confirmed the stories, which attracted larger crowds. The loop continued until it didn't, and when it stopped, the people who had arrived late, the people who had heard about the opportunity, not from fundamental analysis but from the social noise of their communities, bore the largest losses. The internet did not invent this mechanism. It accelerated it. It gave the loop a new transmission medium, one that operates at a speed, a scale, and a psychological intimacy that the coffee houses of Amsterdam or the railway share subscription rooms of Victorian London could not have achieved. But the structure underneath is identical. The human brain running the loop is the same brain that ran it in 1637, in 1720, in 1845, in 1999, in 2021. The only variable that has changed is the speed at which the loop completes its revolution. The human brain was not designed for financial markets. This is not an insult. It is an observation about the mismatch between the environment in which human cognitive architecture evolved and the environment of modern capital markets, a mismatch that social media exploits, with a precision that would be impressive if its consequences were not so consistently destructive. Consider the cognitive mechanism called social proof. Robert Cialdini, in his foundational work on influence and persuasion, identified social proof as one of the most powerful shortcuts in human decision-making. Human beings look to the behavior of others as evidence of what the correct course of action is. This is, in environments where the people around you have relevant and reliable information, an entirely rational heuristic. If everyone in your hunting party is running in the same direction, it is probably not the moment to stand still and question the consensus. In financial markets, social proof becomes a liability of the first order. Because in financial markets, the behavior of others is not reliably informative about value, it is reliably informative about the current state of collective psychology, which is a different thing entirely. When a large number of people are buying a stock, this tells you that a large number of people are buying a stock. It does not tell you anything reliable about whether the stock is correctly priced, underpriced, or dangerously overvalued. But the brain does not naturally make this distinction. The brain, shaped by hundreds of thousands of years of evolution in social environments where consensus was a reliable signal of truth, experiences the buying behavior of a large crowd as evidence that the crowd has information you don't, and that the correct response is to join them before the opportunity closes. This tendency is dramatically amplified by the fear of missing out, the psychological state that behavioral economists have documented as one of the most powerful drivers of financial decision-making errors. FOMO, as it has been colloquially labeled, is the emotional experience of watching others appear to benefit from an opportunity you are not participating in. It is, functionally, a form of social pain, the pain of exclusion, of falling behind, of being left on the wrong side of a dividing line between those who acted and those who didn't. And it is acutely activated by exactly the kind of social media content that dominates financial communities during market manias. The brokerage screenshots showing enormous gains, the testimonials of life-changing profits, the shared language of a community that has found something special and is growing every day. The brain that experiences FOMO is not reasoning. It is in a motivated state, driven by a desire to end the pain of exclusion that will accept far weaker evidence for action than the same brain in a calm state would require. The motivated brain takes the social consensus as its primary input, frames urgency as a necessary feature of opportunity rather than a warning sign about quality, and generates justifications for action rather than reasons for caution. This is not weakness of character. It is the normal operation of a cognitive system that was not designed for this environment. Add to this the specific mechanics of social media platforms. The dopamine architecture of these platforms, the variable reward schedules of likes, upvotes, and follower counts, is well documented to create patterns of engagement that bear structural similarities to the behavioral patterns observed in gambling. The intermittent reinforcement of social validation. Sometimes your post gets massive engagement. Sometimes it doesn't, and you can never quite predict which outcome a given post will produce is one of the most powerful conditioning mechanisms available. It keeps people coming back. It keeps them posting. And in financial communities specifically, it rewards the posts that generate the most social response, which, as we have already established, are not the posts that contain the most rigorous analysis. The result is an environment that is doing several damaging things to investors simultaneously. It is replacing diverse, independent information with homogenized, socially amplified narratives. It is activating the brain's social proof mechanisms and FOMO responses while suppressing its capacity for independent critical analysis. It is rewarding emotional content over analytical content, creating a community culture in which confidence is more highly valued than accuracy. And it is doing all of this at a pace that leaves no space for the kind of slow, deliberate thinking that careful investment analysis requires. The psychologist Daniel Kahneman spent much of his career studying the relationship between two different modes of thought, what he called System 1 and System 2 thinking. System 1 is fast, automatic, associative, and emotionally responsive. System 2 is slow, deliberate, analytical, and effortful. System 1 is what handles most of your daily experience. It is the system that reads faces, recognizes danger, and generates gut feelings. System 2 is what you engage when you are solving a math problem, reading a legal contract, or evaluating the financial statements of a company you are thinking of investing in. Social media, in its mechanics and its pace, is a System 1 environment. The scrolling feed, the rapid-fire posts, the visual signals of community enthusiasm, these are all inputs that System 1 processes automatically and responds to emotionally. System 2, the careful, effortful, analytical system, requires deliberate activation, quiet space, and time. It does not get activated by a scroll feed presenting you with rocket emojis and screenshots of 100% gains. It gets bypassed by it. The combination of all of these factors, social proof, activation, FOMO, dopamine conditioning, the suppression of system to thinking, the homogenization of information through algorithmic amplification, creates a decision-making environment that is almost perfectly engineered to produce the following sequence. Investor discovers popular stock through social feed. Investor experiences social proof and FOMO response. Investor buys stock at or near its peak of social media attention, and therefore near its peak price. Stock declines as the pool of new participants exhausts itself. Investor suffers loss. This sequence is not occasional, it is systematic, and it shows up in the data with a consistency that is striking. The academic research on social media volume and subsequent stock performance is, by now, extensive enough to support conclusions that should be discomforting to anyone who has ever taken a hot Reddit tip as a buy signal. A landmark study published in the Journal of Finance examined the relationship between the trading activity of retail investors tracked through brokerage data and subsequent stock returns over a 20-year period. The finding was consistent and significant. Stocks that experienced heavy retail investor buying attention subsequently underperformed the market. The more enthusiastically retail investors piled into a stock, the worse it performed in the months and years that followed. Research specifically examining social media volume has reinforced this finding in the modern context. Studies examining the correlation between Twitter mention volume, Reddit, post frequency, and StockTwit's activity for individual securities have consistently found that high social media volume is a negative predictor of subsequent returns, particularly in the short to medium term. After controlling for other variables, stocks that go viral tend to go viral near their price peaks, as the social attention is itself partly a consequence of prior price appreciation that has generated the stories, screenshots, and testimonials that drive the viral spread. The GameStop situation of January and February 2021 is the most dramatic single data point in this literature. But it is not an outlier. A systematic analysis of the stocks that achieved the highest Wall Street Bets mentioned volumes across the 2022-2021 period shows a near universal pattern. Dramatic price appreciation followed by dramatic price decline, with retail investors who entered at high attention moments bearing the largest losses. AMC Entertainment, Bed Bath & Beyond, BlackBerry Palantir, during its peak social media attention phase. The pattern repeats with a fidelity that suggests it is not accidental, but structural, that the mechanism producing it is the same mechanism every time. The reason for this is, in retrospect, straightforward. The price of a stock at any given moment reflects the expectations and capital of the participants currently invested in it. For a stock to continue rising, it requires new investors to arrive with new capital, willing to pay prices higher than those paid by existing investors. Social media attention drives this process temporarily by expanding the pool of potential new investors, by making the stock visible to people who were not previously aware of it or interested in it. But social media attention is a finite resource. The number of people who will see a post about a given stock, feel the FOMO response, and convert that response into a market order is not infinite. Once the attention has peaked and the pool of available new participants begins to thin, the mechanism that was driving the price higher simply stops operating. And when it stops, gravity reasserts itself. The stock does not necessarily fall because anything about the underlying business has changed. It falls because the social momentum that was carrying the price, disconnected from fundamental value, has exhausted itself. The story ends not with a bang, but with the quiet observation that there is no one left to tell it to. This dynamic is captured with unusual clarity in the work of the economist Robert Shiller, who spent decades studying the role of narrative in financial markets. Shiller's central insight, developed across multiple books and culminating in his concept of narrative economics, is that popular stories, the narratives that achieve wide social circulation and become part of the common vocabulary of an investment community, are themselves economic forces. They move capital, they change prices, they create self-fulfilling dynamics in which the story and the price reinforce each other for a time, until the story exhausts its audience and the self-fulfilling dynamic reverses. The extraordinary contribution of social media to this process is not that it creates new types of narratives. It is that it allows narratives to travel further, faster, and to more people than any previous medium, and then collapse faster when the travel ends. The same mechanism that made GameStop feel, in January of 2021, like the most important financial story in the world, made it feel, by March of the same year, like an embarrassing episode that everyone involved would prefer not to discuss. The amplitude of the cycle has increased. The duration has decreased. The emotional intensity at every phase has become more acute. But the shape of the curve, rise, peak, fall, is the same shape it has always been. There is a letter that Warren Buffett wrote to the shareholders of Berkshire Hathaway in 1986 that has been quoted often enough that it risks becoming a cliché, but that bears examining here in its specific logic. In it, Buffett described his investment philosophy with characteristic plainness. Be fearful when others are greedy, and greedy when others are fearful. The investment community has repeated this line for 4 decades. Fewer people have thought carefully about what it actually describes. It describes a systematic inversion of the social proof mechanism, a deliberate policy of treating the enthusiasm of the crowd not as a signal to join, but as a signal to step back and examine what the crowd is so excited about with considerably more skepticism than it is currently receiving. This is not contrarianism for its own sake. Buffett is not arguing that the crowd is always wrong. He is arguing that the price you pay for an asset is the primary determinant of your return from it, and that the price of an asset tends to be highest precisely when social enthusiasm for it is highest. And therefore that social enthusiasm is as an indicator of investment opportunity, perversely inverted from what most people intuitively assume. The logic is simple enough to state, but psychologically demanding to implement. When a stock is at its most socially prominent, when it is appearing on the front pages of financial news sites, trending on social media platforms, being discussed in workplaces, and at dinner tables, generating the kind of ambient social noise that makes it seem like everyone in the world knows about it and wants to own it. That is the moment at which the pool of potential future buyers is most depleted. The people who are going to buy this stock based on its story have, in the main, already bought it. The marginal new buyer, arriving now because the social noise has finally reached them, is likely paying a price that reflects the enthusiasm of all the buyers who came before them. The investors who have demonstrated the most durable long-term track records are notable not for their information advantages, but for their relationship with social consensus. Howard Marks, the co-founder of Oaktree Capital Management, has written extensively about what he calls second-level thinking, the capacity to not just ask, "What do I think about this?" but "What is the consensus thinking about this, and how is that consensus thinking reflected in the current price?" The investor who thinks at only the first level, who asks, "Is this a good company?" rather than, "Is this a good company at this price, given what everyone else already thinks about it?" will consistently arrive at the same conclusions as everyone else, and will therefore achieve the same results as everyone else. Average returns at best, and significantly below average returns when they are consistently arriving at those conclusions at moments of peak social enthusiasm. The historian of financial bubbles always encounters the same phenomenon at the peak of any mania. A community of intelligent, articulate people explaining with great sophistication why this time is different, why the usual rules of valuation do not apply to this particular asset, why the price, which appears by conventional measures to be disconnected from any reasonable assessment of underlying value, is in fact correct, is in fact conservative, and will continue to rise. The sophistication of the rationalization tends to scale with the sophistication of the community producing it. The tulip traders of 1637 had their arguments about the intrinsic scarcity of rare varieties. The dot-com investors of 1999 had their arguments about the transformative nature of internet adoption curves and the obsolescence of traditional valuation metrics. The GameStop community of 2021 had their arguments about short-squeeze mechanics and the moral dimensions of retail investors reclaiming capital from hedge funds. Each of these rationalizations contained genuine elements of truth. Rare tulip varieties were genuinely scarce. The internet genuinely was transformative. The GameStop short squeeze was a real financial phenomenon with real mechanics. The problem was never that the underlying observation was false. The problem was that the price already reflected not just the truth of the observation, but the enthusiasm of a community that had been building on that observation for weeks or months at ever-increasing emotional intensity. A community that had, by the moment of peak attention, priced in not just the true value, but the hope and the story and the social energy and the FOMO of everyone who had arrived before the last person to arrive. The last person to arrive always pays for all of that. There is a particular kind of investor who does well over long periods of time, and the quality they share is not intelligence in the conventional sense, not access to better information, and not superior analytical tools. It is the quality of being genuinely comfortable with the experience of being wrong at the exporsal level, of holding a position that the community around them considers either boring or mistaken, of being unable to share a thrilling story at dinner because the investment thesis is essentially this company is unglamorous and underpriced and nobody is. Talking about it, of being excluded from the social electricity of a rising meme, stalked by a settled understanding that the electricity is the warning. This comfort is not natural. It runs directly against the social brain's desire for belonging, for consensus, for the warm feeling of being on the right side of a shared story with a large and growing community. It requires a kind of ongoing resistance to the most fundamental social drives that human beings possess, exercised specifically in the domain of financial markets, specifically in the moments when those drives are most powerfully activated. It is not a coincidence that Buffett has, throughout his career, maintained a studied distance from financial media. That Benjamin Graham, the father of value investing and Buffett's intellectual mentor, spent his career emphasizing the concept of Mr. Market as an irrational counterparty whose emotional moods were to be exploited rather than emulated. That John Templeton, who built one of the 20th century's most extraordinary investment records, was famous for buying at points of maximum pessimism, the moments when social consensus had moved furthest in the direction of despair, and the community around any given asset was at its smallest and quietest. The pattern is consistent. The investors who have compounded wealth over decades share a systematic relationship with social attention. That is the inverse of the relationship most people assume leads to good investment outcomes. They do not follow the crowd, they watch the crowd. And what the crowd tells them, through its enthusiasm and its volume and its momentum, is primarily this: the opportunity that was here has already been priced away. The story of the Massachusetts man who bought GameStop at its peak and watched the price fall is not a story about the failure of one individual's judgment. It is a story about the systematic operation of a mechanism that is older than the internet, older than the stock market, older than organized finance in any of its modern forms. It is the story of social proof operating in an environment for which it was not designed. The story of FOMO, activated by platforms that have made the activation of FOMO their primary commercial product. The story of the narrative and the price reinforcing each other in a reflexive loop until the loop exhausts itself, at which point the story ends and the price falls, and the last people to arrive are left holding assets that are worth considerably less than what they paid for them. The mechanism will operate again. It is operating right now in some corner of the financial internet with some asset whose name you might not yet recognize. There will be posts and memes and screenshots and testimonials. There will be a community that is growing and confident and loud. There will be a story that feels new and urgent and different from all the previous stories that turned out to be versions of the same story. And there will be people for whom the most rational decision of their financial life will be to buy what everyone around them is buying, because everything they can see tells them that this is what rational people do. The paradox at the center of this story does not resolve cleanly. It does not produce a simple rule that can be applied without judgment or error. Markets are complex, and there are cases in which genuine information precedes social noise, in which early social attention is a leading indicator rather than a lagging one, in which the crowd is early rather than late. The argument here is not that every trending stock is worthless. It is that trending social attention is a profoundly unreliable signal of investment quality, that the correlation between social media, volume, and subsequent returns is, in aggregate and over time, negative rather than positive. And that any investment approach that treats online enthusiasm as primary evidence for a buy decision is operating on a framework that the evidence consistently and thoroughly undermines. The deeper argument is about what kind of information you should be looking for and where you should expect to find it. The information that matters most for long-term investment returns, the gap between a company's intrinsic value and its current price, is not the kind of information that trends on social media. It is not emotionally exciting. It does not generate rocket emojis. It does not produce the social electricity of a community moving together in a shared story. It lives in the quiet places, the annual reports that nobody reads, the industries that nobody finds interesting, the companies whose names have not yet become content. The genuine opportunity, almost by definition, does not announce itself loudly. It cannot, because if it announced itself loudly, the crowd would arrive, and the crowd's arrival would price away the opportunity before you could act on it. The noise is not the signal. The noise is the warning. And the silence, the particular, uncomfortable, socially alienating silence of an investment that nobody is talking about, is, more often than you would expect, and more reliably than any algorithm has yet captured, where the signal actually lives. The crow lifts from the branch, the crowd moves on. The field is quiet again, and in the quiet, if you are patient enough and honest enough about your own social brain's desire to follow the noise, you might find what was always there, waiting to be seen by whoever could stand the silence long enough to look.